Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, the AI craze is changing the landscape for businesses and the workforce. Constellation's Ray Wang will share his insight on how investors can best navigate it. Then our panel makes a case for a tool that can help you build wealth for retirement despite the bad rap it gets from some experts. And later, why Ben & Jerry's ice cream business is a hot potato. But we begin, as always, with our expert panel and 3 things investors should be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Andrew Barry, and Elizabeth O'Brien. So, Ben, yet another record week for Wall Street. Was this all about the Fed, or is there more going on?
There's actually some more going on. I mean, don't get me wrong. The Fed got people excited. Everyone had thought that the forecast for future rate cuts would drop from 3 to 2, but it actually stayed the same despite some hot inflation readings to start off the year. But I think the real thing that got them excited again this week is just artificial intelligence. We had NVIDIA had its AI day or AI conference this week. We had Micron with some great earnings thanks to, you guessed it, AI. And Broadcom also had an investor day where it highlighted the AI opportunity, and that really drove tech stocks higher. We also had a big tech IPO in the form of Reddit, gained 50% on his first day of trading, despite trading at 10 times sales.
And Truth Social came out as well. Well, it didn't actually come out, but there's a SPAC that's sort of the equivalent of an IPO. Andrew.
Yeah, Donald Trump's company is going to debut as Trump Media under the ticker DJT on Monday. And the market value based on where the SPAC was trading on Friday is around $5 billion. And that's a very high valuation, given the fact that the company generated about $3 million in revenues in the first 9 months last year and no profits. I mean, Trump's stake is worth about $3 billion on paper. I'd emphasize on paper. I'm not sure whether he will ever be able to monetize it, that for anything close to that $3 billion value, given the fundamentals of that company.
Yeah, if you thought Reddit was expensive at 10 times, this is roughly 1,000 times. This is sales, not earnings. Hardy, I'm glad Chairman Powell, investors don't seem too worried about inflation, but I'm not sure we're out of the woods yet.
No, I don't think we are either. And I suspect Powell knows that. I was looking at the 5-year inflation-protected securities market. These are TIPS, the treasuries that price and protect you from inflation. And we've seen the amount of inflation priced into those go up to 2.43%. That was from about 2.05% in December. And if that keeps going up, the Fed is going to have to start worrying because it really needs inflation expectations to be anchored. But we're also seeing other central banks are in this cutting kind of mode, or at least wanting to ease things, with the Swiss National Bank actually going out and doing a surprise cut.
Which I think is good news. Real quick, can the rally continue next week, you think?
No, I think it can. I mean, everyone gets freaked out when the market's hitting new highs. It's like, oh my gosh, you're hitting new high after new high, and we've had a bunch of them this year. But usually that's a good thing. That's how the market goes up and how it's been such a great investment for people over time. So I think, yeah, you just keep riding it.
All right, one stock that's not rallying right now, Andrew, is Apple. And the Justice Department just announced this antitrust suit, long-awaited antitrust suit. What do you make of it?
Well, it looks like an overreach by the Biden administration again on the antitrust front. I don't think it's going to have anything like any real success in terms of making a major impact on the way Apple operates. It's essentially the government saying that Apple operates as a monopoly in the smartphone market with its integrated system of its ecosystem of the phone, the watches, services, and software. And they're trying to basically change all that. But Apple says it will, if the government's successful, it's going to hinder their ability to operate. I think that's right.
So what do you think of the stock here?
I think, Gene Munster, an analyst, said that he thinks the ultimate thing that's going to happen is that Apple makes some small changes that really don't have much impact on the business. I think the stock's looking fairly attractive. It's around 172 right now. It's been one of the worst performers among the big tech stocks, down about 10% this year, trading for around 25 times this year's earnings, which isn't bad, considering you could see some acceleration in growth next year. And one thing Apple ought to consider doing is paying a bigger dividend, just 0.5%. And one thing to watch is Warren Buffett and Berkshire Hathaway. They're among the biggest holders of Apple. Berkshire cut his stake in the fourth quarter. People will be wondering, does Buffett cut the stake further in the first quarter, even though may not know for another month or so?
A lot of people here are making the comparison to Microsoft 2 decades ago. Yeah. Regulators went after it. Well, not only has Microsoft thrived, but that enabled companies like Google and even Apple to rise from the dead and oxygenate the system. So I think everyone might be okay here.
Yeah.
I want to ask you, Elizabeth, about a real hit that Humana stock has taken this year and some other stocks as well. And apparently it all goes back to Medicare Advantage problems. Can you explain that?
Sure, that's right, Jack. Now, Medicare Advantage is, of course, the privately run alternative to traditional Medicare. It's also known as Part C. You can barely turn on daytime TV without seeing a commercial for it with pitchmen like William Shatner and Joe Namath. It's been very popular with consumers, now enrolls more than half of the eligible Medicare population. It's been lucrative for insurers, but there's signs that the economics might be shifting. Like you said, Humana earlier this year said that healthcare utilization was way up. Basically, people are going to the doctor more than they expected. That's putting, cost pressures on them. And as a result of these pressures, they had to sharply reduce guidance, causing headaches for investors.
Broadway Joe likes it. I think I like it too. But what does this mean for recipients?
That's a good question, Jack. Now, nothing is going to happen this year because contracts are fixed for 2024, but it's definitely something to watch for 2025. We'll know this fall when open enrollment starts for 2025. It's possible that certain extra benefits might have to be curtailed, like the gym memberships. They even have perks for your pet these days, some of them. And premiums might also have to go up.
Pet insurance. Let's go back to the stocks, though, briefly. So obviously, Humana took a hit, some other companies as well. Is this margin pressure?
It is indeed, yeah. Humana stock is down about 23% for the year. Now, it's the purest Medicare Advantage play. United Healthcare also has a Medicare Advantage business and some other players, but Humana is the most exposed. And indeed, there are cost pressures and margins are getting squeezed.
All right, we'll hear more about this as the year goes on. We find out what 2025 premiums will be.
Exactly.
Alrighty, AI, meanwhile, is transforming Wall Street as companies try to navigate the biggest tech transformation since the dot-com boom. Constellation's Ray Wang shares his insight and some investment opportunities next. AI is center stage for investors right now, and it's shaking up how companies do business. My next guest says the technology is the real fourth industrial revolution. Joining me now is Constellation Research principal analyst and founder, Ray Wang. Ray, you're just back from NVIDIA's big conference. Thanks for joining us all the way from Silicon Valley. You called it the Davos of AI. And look, we've all seen NVIDIA dominate the AI conversation, but you also have named some other big beneficiaries of this AI revolution, the way Coca-Cola benefited from the invention of the fridge, to take your comparison. Could you start with Taiwan Semi?
Yeah, Taiwan Semiconductor, those are the ways of how you're building the AI chips. They basically put together the layers, they put everything together and connect. That's actually the technology that gives NVIDIA the 2-die capability. And that's actually, that's the future of chip manufacturing. 3 nanometer to 2 nanometer, they're in the middle of that action.
We could spend an hour on this, but briefly, can you explain the 2-die benefit?
Yeah, so what they're able to do now is actually compress more processing capability with the 2 chips, with their 2 dies, and that's actually packs a lot more processing power in the chips, and it's a specialized technology that TSMC perfected, working with NVIDIA and a whole bunch of other partners.
Okay, thanks. So obviously software is huge in this too. Let's go to Oracle. Larry Ellison's company is going to be a big beneficiary as well, you believe?
Yeah, one of the reasons people discount Oracle in the race is because they weren't first to the cloud. And what they were able to do that was different is that they built a cloud infrastructure. They actually built a lot of autonomous capabilities in their database, and they started moving up the stack. And Oracle has probably some of the best enterprise software products, and those are actually getting autonomous capabilities, AI capabilities, and ML. And companies that are using Oracle are going to see the full benefit from the cost savings there, as well as the predictive insights.
And one more, Google, which has seemed to be a little bit behind Microsoft in this race, but you think there are good things ahead?
Yeah, I kind of want to correct that misconception. Okay. Google is still ahead of Microsoft in AI. Microsoft has just been really good at consumerizing the messaging and marketing and packaging of AI, making it available to everyone. So the Google technology that's there, I think Google was trying to wait a little bit longer than Microsoft to get stuff right before they launched, but Microsoft jumped the gun and forced Google's hand. And the reason Google's got all that capability is because they've got the cloud capability and they've got all the technology from their DeepMind research and all the other AI capabilities they've been building over the last decade.
They just need better PR.
Better marketing, better go-to-market.
All righty. I want to bring this down maybe to the viewer's everyday life. Could you give us an example of a way in which AI is going to change our everyday lives? How does it benefit the viewer?
Yeah, I mean, we've got to look at AI in a couple of ways. There's some things that we hear about in terms of taking repetitive tasks, making it a lot easier for folks, right? So normally, let's say you actually want to order your groceries. An AI-enabled refrigerator will know what's in the refrigerator, how much milk you need that week, how much bread you're going to want, how much you need to fill up your pantry, how many eggs you need, and it'll make the orders for you. It'll happen in the background. That's where we're trying to get to. Other things from scheduling. Let's say you wanted to accomplish 13 tasks that today, like you got to pick up the kid, go to the dentist, you want to pick up groceries somewhere else, you want to make sure you catch up with your friends in the evening. Scheduling systems are going to pop up to make your life a lot easier in the background as well. Or you walk into a meeting and you don't know everybody's names, you don't have the context of when they met them, and a simple assistant will pop up and say, oh yeah, that's Jack. I met him at this conference on this date, and by the way, here are the 5 things he likes to talk about.
All righty, I'm starting to hear some benefits there, although I think I can keep my own grocery list. Anyway, before we go, I do have to ask about something you identified as what I would say is a major risk. You called it extinction risk. Let's end on a bad note, Ray. Can you explain that?
It's hard to end on a bad note on your show, but let's just say there's possibilities that the AI decides that humans are the problem and they decide to take us out, and kind of in your classic, matrix model that will happen. But hopefully, if we're smart, we'll make sure there's a human in the loop, and that never happens.
Yeah, I sure hope not. Skynet should stay far away. Anyway, Ray Wang, thanks very much for your insights. Let's hope we're talking for years to come without AI getting involved.
Thanks a lot. Take care.
News for retirement savers. Experts might be wrong when they bash your investment options. We'll look at a pair of underrated tools to help build and preserve wealth next. Experts have been telling retirement savers to avoid annuities and target date funds to prepare for their golden years. But before you dismiss them, take a closer look. Elizabeth, assets in target date funds have climbed to around $3.5 trillion while no one was looking. Why do they get a bad rap?
Yeah, people love to hate on target date funds. And, one of the reasons why is they had a bit of an existential crisis in 2022. But just to back up, target date funds are these cookie cutter funds that help people save for retirement. You sort of choose the year that best corresponds to the year that you plan to retire. They provide a professionally managed mix of stocks and bonds, so that gets more conservative as you approach retirement. So, the stocks go up, the bond allocation goes down. And in 2022, as we all know, bonds tanked. And so people were saying, they didn't do their job. They didn't provide the ballast that they're known for. Is the model broken? So people were all worried about that. So that's one reason why people love to bash target date funds.
Yeah, another issue has been that target date funds tend to have a reasonable amount of international stock exposure, and that's hurt them in the last 5 to 10 years as foreign stocks have trailed behind the U.S. And so, for instance, the Fidelity Freedom funds, which are their target date funds, have almost half their equity exposure internationally right now. So that's hurt, but it could help if international stocks finally start outperforming.
Diversification means always having to say you're sorry. What are the benefits here, Elizabeth?
Well, I think that, for people who don't have the time or the interest or the aptitude to manage them on your own, which is frankly most of us, I don't really have the interest in doing a deep dive on my retirement finances.
And you're in the business.
And I'm in the business. I'd rather do other things. So anyway, they can be a very good option, I think. So I think a lot of the criticisms are perhaps unfounded, or at least... Yeah.
And you can tweak them a little bit. So, for instance, if I think, I want to take a little more risk, I could put 90% in a target date and 10% in the S&P, or alternatively, 10% in a bond fund if I want to be more conservative.
Sure, you can absolutely mix it up. You don't have to stay with the target date fund. You also don't have to stay with your own target date fund. Let's say you plan to retire in 2040, but that asset mix is too conservative. You don't want that many bonds. Well, pick the 2050 fund or even the 2060 fund. For a story I recently did, I talked to a man in his 60s who was in the 2065 target date fund because he wanted aggressive allocation. He had conservative assets elsewhere. So you don't have to be wedded to your own. Yeah.
And you could do a lot worse than this. Let's talk about maybe an even bigger 4-letter word in the investment world, which is annuities. I'm hearing more and more about annuities and retirement plans.
Hey, I got to stop you there, because it used to be a few years ago even that if an advisor said, hey, we should put an annuity into your 401k, you'd go find a new advisor. What's changed?
Well, these are not your father's annuities, these are different. The annuities that got a bad rap, and sometimes deservedly so, were often variable annuities that had very high fees, high surrender charges. They were just not the greatest investments. But the ones that are now starting to crop up in 401k plans are fixed annuities, which have historically been lower cost. Now in 401k plans, they're even lower because you've got institutional pricing, and so they're definitely a different sort of breed of annuity that's worth a look for guaranteed, like to divert a portion of your 401k into guaranteed income for life.
So who should be using these in their retirement accounts? I mean, I'm 51. Should I be owning an annuity in my 401k?
Yeah, I mean, some of the companies that are providing them are starting to say people even younger should get into them to sort of create their own pension as they go along, contribute to it throughout their working career. I'm not so sure about that. From what I hear from advisors, a good time to buy if you're going for a fixed annuity is right when you need it. In retirement or approaching retirement, you calculate your expenses. You say, okay, I want my expenses, my essential expenses to be covered by Social Security or an annuity. That's a common thing. So here's how much I need. Let me go buy the annuity. You don't sort of buy it way in advance.
Yeah, and the rates on annuities probably aren't that bad right now in fixed annuities. Probably around 5, sometimes maybe even 6%.
Exactly. With interest rates going up, they're very competitive right now.
I got to agree, though. Don't annuitize until you actually retire. Take those times during your working years to invest in growthier things like stocks.
Yeah, and that's all the more reason to just invest more aggressively for retirement. Just to, get as much assets, accumulate as much assets as you can, so you have a bigger portion to annuitize when the time comes.
And if you were someone like Warren Buffett, he would tell you to keep it simple and for your retirement, and maybe just invest in an S&P 500 index fund and maybe like a bond fund like the EGG ETF, and you could adjust your mix over time.
One more thing, there's a horrible expression called longevity risk. I mean, we should all be so lucky, right? But sometimes financial people will use that term to describe running out of money.
Right.
What is one more way to avoid running out of money, Elizabeth?
Well, in addition to annuities, just to save as much as you can, to park as much, whether you go with a target date fund or just like Buffett, a regular S&P 500 index fund, or whatever you go with, invest as much as you can. Now, financial advisors generally recommend 15%. You put away 15%, including your company match of your paycheck. Now, that might seem like a ton, and you can work your way up to that slowly over the years, but that should be, if possible, the goal is to sock away 15% of your paycheck.
And the sooner you start, the better return you'll get.
Absolutely. Harness that compound interest.
Thanks, guys. Ben and Elizabeth have a pair of investment ideas, and Andrew says it could be a rocky road for Ben & Jerry's ice cream business. Stay right there. Andrew, from the Nothing is Sacred file, now even ice cream is getting a bad rap?
I know. Wall Street is not screaming for ice cream these days. Unilever, which is the biggest global player in ice cream, is getting out of the business. It's likely going to spin it off to its shareholders. It owns such brands as Ben & Jerry's and Breyers and Popsicle. And some of the reason is that it's become a slow growth business. Unilever's ice cream sales were only up about 2% last year. And it's expensive to operate, given it has to be kept frozen. And also, you've got the Ozempic effect, which is affecting a lot of food companies. People are worried about, ice cream sales being negatively affected by this. And it also shows some of the distortions that can be caused by the whole ESG movement. Ice cream doesn't score well with a lot of ESG investors because of the carbon footprint of ice cream. And therefore, if Unilever gets out of the business and they have higher scores, even though the business is going to still be around and just owned by someone else.
So will you be an owner? Will you buy a spun-off ice cream business?
No, it's actually a pretty good business. And like Kellogg, which was another orphan food company, the cereal company, it's actually done very well since its spin-off from what's now the company Kellanova.
And you can't blame this on Ben & Jerry. Nestle is also getting out of the ice cream business.
About 5 years ago, Nestle sold its ice cream business, which includes Haagen-Dazs, into a joint venture. And so it's not something that, big corporations seem to want to be in anymore, despite, the popularity of it.
It's all going the way of Frusenglaschen. What's your favorite flavor?
I love chocolate chip. You can't find it very much anymore. It's an old-fashioned flavor.
Ben?
I like something called daiquiri ice, which I'm not even sure gets made anymore, but Baskin-Robbins.
Elizabeth?
I like anything with coffee in it.
All righty, let's go to actionable ideas. I'll stick with you, Elizabeth. What's your thought?
Okay, well, I'm going to steal one from Andrew over here, who has a piece coming out on London-based Anglo American. It's a leading miner of copper, iron ore, diamonds, platinum. It partly owns De Beers. Now, it's had a challenging stretch. It's down 24% over the past 12 months, but management is vowing to cut costs, and it also could be acquired. So either of those scenarios would be good for investors.
And Dr. Copper recently caught a bid, which is good for Anglo American and could be good for the economy.
Mm-hmm.
Ben, what do you have for us?
I'm looking at advanced micro devices, AMD. NVIDIA had its investor conference this week, and that was great for chip stocks, except for AMD. Everyone's worried that it's really not going to have a role in this future of AI. I think it's overdone. It's fallen about 15% from its high of the year, and it looks like it's found support around 175. If that holds, looks like a good place to buy the dip.
All righty. Thanks, Ben. Thanks, Elizabeth. Enjoy some ice cream this weekend, Andrew. And that's all for us. To read more, check out this week's edition at barrons.com. Don't forget to follow us on X, that's the former Twitter, at Barrons Online. And that's all for us. We'll see you next week on Barron's Roundtable.